Shanghai. The problem of heavily indebted state-backed companies in China spook investors in global corporate bonds. As liabilities balloon at Chinese civil engineering and construction companies engaged in public works projects to shore up the economy, premiums on foreign currency denominated are rising. The bonds are under selling pressure because investors believe the Chinese government will no longer bail out state-owned enterprises. A sudden spike in defaults by big corporate borrowers in China could rattle global markets. Hello everyone, welcome to World of China. In today's video, we are talking about the private banking units of Citigroup Inc. and Credit Suisse Group AG have stopped accepting the bond. So stay tuned and hit the subscribe button. According to people familiar with the matter, the private banking units of Citigroup Inc. and Credit Suisse Group AG have stopped accepting the bonds of Fantasia Holdings Group Company as collateral amid rising concerns about the Chinese developer's financial health. The banks have assigned a zero lending value to the notes, meaning their confidential customers can no longer use them as security for loans. The matter is zero. Representatives from Citigroup and Credit Suisse declined to comment. Fantasia said it's working on bond buybacks, declining to comment further. The development underscores Fantasia's investors' concerns as the company joins a slew of Chinese developers under stress. As a result, Fantasia's longer 1,000 rand notes have plunged, and in August were the worst-performing names in the Bloomberg Index of Chinese high-yield dollar bonds. Concerns over property giant China Evergrande Group have turned investors sour on riskier junk bonds. Fantasia is rated the equivalent of B in all three major international risk assessors. Moody's Investor Service changed the outlook of the developer from positive to negative in July. Beijing's policy moves are hitting Chinese corporate bonds and rippling across global markets through the US and European money managers who have recently loaded up on the securities. Emerging markets investors have long been subject to such shocks. Still, Chinese bonds are now so widely held that swings in their prices are affecting even bond funds that don't specialize in developing countries, including funds managed by firms such as Pacific Investment Management Company and BlackRock Incorporated. Foreign investment in China's vast domestic bond market has soared, making the country an outlier amid the bond rout roiling other emerging markets. China took landmark steps from 2016 to open its bond market, the world's third largest behind the US and Japan. But foreign investors were initially wary. The opening measures occurred during renminbi depreciation when Chinese regulators were also clamping down on capital outflows. That raised fears that foreigners, once in the market, could find themselves unable to exit. Those concerns have faded. The renminbi is the official currency of the People's Republic of China, has stabilized. Capital flight has subsided, and regulators have grown more relaxed about permitting outflows. That has allowed investors to refocus on the attractive yields available on Chinese debt. Foreign ownership of Chinese onshore bonds reached 1.36 trillion renminbis, or $214 billion at the end of March, an increase of more than 60% from a year earlier, according to People's Bank of China data. Global bond funds with the most Chinese corporate debt lagged behind their benchmark indexes over the month that ended last Thursday, according to a Wall Street Journal analysis of data from Morningstar Inc. The underperformance coincides with declines in stocks and bonds of Chinese private education, technology, and property companies triggered by regulatory and policy changes. Foreign investors purchased a net 170 billion renminbis of Chinese government bonds this year through April, clearinghouse data show, nearly 4 times the net purchases of the Chinese commercial banks that have traditionally dominated the market. Yet, foreigners still own less than 2% of the 77 trillion renminbis in outstanding notes in China's onshore market, leaving plenty of space for growth. Analysts said that inclusion in major global bond indices would be the most significant catalyst for inflows since exchange-traded funds that passively track such index would be forced to buy in. The three most influential global bond indices could eventually generate foreign inflows worth $286 billion, Standard Chartered estimated. 10 non-emerging markets bond funds, with the most prominent Chinese corporate bond holders by dollar amount, 9 underperformed their benchmarks at the height of the recent turbulence in Chinese debt markets, analysis of the Morningstar data shows. However, some of the fund's performance turned positive in recent days as Chinese corporate bond prices rebounded. More turmoil is likely to come, particularly for property companies with junk credit ratings, said Neuberger Berman Group LLC Emerging Markets Fund Manager Nish Popat. "We don't think we're completely out of the woods yet," he said. Investment-grade bonds are also at risk. Prices of Meituan's BBB-rated bond due in 2030 fell on Friday to about 90 cents on the dollar, according to data from Market Access, down from face value or 100 cents in mid-July. In one sign of the heightened regulatory scrutiny Meituan faces, the Wall Street Journal reported Friday the Chinese regulators plan to impose a roughly $1 billion antitrust fine on the company. According to the International Capital Market Association, Chinese companies have roughly $6.55 trillion of bonds outstanding, with $752 billion sold in foreign currencies such as the dollar. After accounting for government debt, the Chinese domestic bond market amounts to about $15 trillion, making it the second largest after the US. At the same time, global bond funds run by Western money managers have grown larger, meaning that even small allocations to Chinese debt can add up to significant sums. Let's take a look at the story so far. February 24, 2016. People's Bank of China opens a channel for most foreign institutional investors to access the country's interbank bond market, where more than 90% of debentures trade. Unlike previous programs, the new scheme requires no prior approval and is not subject to quota restrictions. February 27, 2017. China grants foreign investors access to its onshore currency derivatives market, enabling them to hedge foreign exchange risks from investments in renminbi bonds. March 1, 2017. Bloomberg declines to add Chinese bonds to its flagship Bloomberg Barclays Global Aggregate Bond Index. As a compromise, the group spins off a parallel index that includes China while keeping the existing flagship unchanged. The impact is minimal because the newly created index is not widely tracked. March 7, 2017. Citigroup follows Bloomberg's path, keeping its flagship World Government Bond Index unchanged, but creating a new WGBI extended index that includes China. Citi also adds China to 3 less influential indices: the Emerging Markets Government Bond Index, the Asian Government Bond Index, and the Asia-Pacific Government Bond Index. Citi sold its bond analytics business to the London Stock Exchange and its FTSE Russell indexing unit 2 months later. July 3, 2017. China launches a scheme to let foreign investors buy into the domestic interbank market through the Hong Kong Stock Exchange. The Bond Connect program streamlines foreign access to the market because it doesn't require investors to set up a domestic account in China. November 9, 2017. The central bank expands risk hedging tools for foreigners, allowing foreign institutions to trade interest rate swaps, bond forwards, and forward rate agreements. March 28, 2018. After rejecting Chinese bonds a year earlier, Bloomberg announced it would add China to its global aggregate index in phases from April 2019. In its announcement, Bloomberg declares that the renminbi is now freely tradable, convertible, hedgeable, and free of capital controls. China has a weighting of 5.5%, which may spark $107 billion in inflows. As Chinese companies elect to default on their debts more often, government bonds and those issued by governmental banks are almost the only places where investors looking for safety can put their money, a foreign bank official said. Data indicate that investors are fleeing from bonds issued by Chinese enterprises and other concerns. According to FTSE Russell, Chinese companies' premium on investment-grade bonds rose by 0.4% over U.S. Treasuries in April. The rise contrasts with narrowing margins from South Korea, Hong Kong, Indonesia, and other bonds against a backdrop of excess liquidity worldwide. The bond market may be dealt a shock if China's implicit government guarantees are hastily reduced. Kenneth Ha of Goldman Sachs warned of the adverse effects of a drastic policy change, saying the government must prevent systemic concerns from spreading. China has promptly brought the COVID-19 crisis under control and attracted investments from abroad, thanks to the higher interest rates its debt offers compared with that of the US and other countries. But the tide is starting to turn as defaults on foreign bonds crop up with growing frequency. That's all for today. Thanks for watching the video. Give this video a big thumbs up and share your thoughts in the comment below. For more exciting videos, subscribe to the channel and hit the bell icon. I'm dropping new videos regularly. Till then, check out the channel for more exciting videos.